Hello everyone. In today's Finance in 3 Minutes series, I'll explain the concept of futures and options, meaning, types, and differences. What are futures and options? A futures contract is an agreement to buy or sell an underlying stock or other assets at a certain price and on a predetermined date. On the other hand, an option contract grants the investor the right but not the obligation to buy or sell assets at a predetermined price on a predetermined date referred to as expiry date. Both futures and options are financial products that investors can use to profit from or hedge against current assets. They are derivative instruments that allow an investor to purchase an investment at a certain price and on a predetermined date. However, the market for these two items are fundamentally dissimilar in terms of how they operate and how dangerous they are for investors. Differences between futures and options. Although both futures and options are classified as derivatives, they are slightly different. In a futures contract, the buyer is required to purchase or sell the assets, whereas in an option contract, the customer is not required to purchase or sell the assets. Features. Features are contracts that must be resolved, paid for after they are entered into. When you enter into a futures contract, you agree to purchase or sell the underlying asset at a certain price on or before a defined date. Features are of two types. Financial futures. Futures contract in the financial markets include stock futures, currency futures, index futures, and interest rate futures. Commodity futures. Commodity futures, energy futures, metal futures, and other are all examples of physical futures. Options. An options contract gives the buyer the right but not the duty to buy or sell the underlying asset at a certain price on or before a specified date. Options trading is an excellent way to trade equities without owning them. If the option buyer wants to avoid purchasing or selling the underlying asset, they may do so. Options are of two types. Call options. A call option entitles the buyer or holder to purchase a predetermined quantity of an underlying asset but does not obligate them to do so. Put options. A put option entitles the buyer or holder to sell a defined quantity of an underlying asset but does not obligate them to do so. How to succeed in F&O trading. Do your homework and do not rely on tips and suggestions. Strict capital allocation and stop loss. Trade with the trend. Have emotions under control. Both greed and fear shouldn't ride your decisions. Cover losses sooner and let the winners ride. That's all about futures and options in brief in under 3 minutes. Thank you for watching.